Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding on air live with Geoff Gannon. Jeff, how's it going today?
Going really well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focused Compound. Go to focuscompound.com to get access to investment rights from Jeff going all the way back to 2005. And of course, hit that like and subscribe button. Really just the subscribe button wherever you are listening or watching us here today to be notified every time we upload a new podcast. So Jeff, before we get into it, and we're going to take some questions from Twitter, talk about some other stuff that's going on in the market, wanted to get your thoughts. Since last time that we recorded, Buffett, his 13F came out, and we have this pull up on Data Roma right now, and you could see that somebody at Berkshire, likely not Buffett, I mean certainly not Buffett,
Probably not.
bought
Yeah.
Google. So wanted to get your thoughts of this. I mean, the stock is up. I mean, this was reported price was $243. It's at $320. I kind of look at Google and I'm like, gosh, that was, I guess maybe the layup of a century investing in it when he did.
Mhm.
Um, uh, we could pull it up on QuickFS and flip through it, but wanted to get your thoughts on Buffett, or I'm sorry, on someone at Berkshire purchase of Google.
Yeah, I don't know. Yeah, I don't think that's Buffett. My guess is if Buffett did do a major purchase in the recent past, the last one was Chubb, and we don't know that he did do Chubb, but that's like the last, top 10 type position that he probably was involved with. And they have kind of added to that over time, I think. No, I just don't think that he did Google.
Hmm.
Um, There have been some small ones, like the Amazon one was a purchase, and then they didn't buy up a lot of it or anything. So I'm never sure about those. These are very big companies though. So they also may be testing to see whether they could buy a big stake in it sometimes. It's hard to know, but they each are managing a lot of money right now, right?
How much are they managing?
I don't know. It's quite a bit if we look. Let's see. Do you have
Yeah.
yeah, okay. So if we look here, basically, um yeah, I would say that Alphabet is kind of the not that there's nothing below it, but everything below that is really, wasn't really Buffett started it. I mean, some's left over and stuff. But so the biggest positions in that are $4 billion positions, and there's a dozen multi-billion-dollar positions in there that I'm pretty sure he had nothing to do with. So yeah, that's pretty big. If you're you know 10th biggest position is like, I mean, if we count them separately, maybe your 10th biggest position is 500 million, but together, it's $1 billion or something, is like one of your smaller positions. So depending on how
Hmm.
diversified they are, but I think they're not that diversified really. Um, so
Hmm. Hmm. Yeah, I mean, so Google, I mean, almost $4 trillion market cap,
yeah.
3.8 trillion enterprise value. Obviously, they have a bunch of cash. They released their new Gemini model, which people have been absolutely raving about. Any sort of AI I've ever used has always been ChatGPT. Um,
Mhm.
So, I guess there's like a sunk cost feeling there to me to like if I was gonna go use Gemini, but a lot of people have been raving about it as being just the absolute best. And supposedly from inside reports at OpenAI, there's, a code red because of the competition. Um, Gemini specifically has set
Mhm.
off a bunch of alarms there. But you just think about YouTube, you think about Google search as well. But Gemini and just the beast that is Google. Yeah. Like for example, are these LLMs going forward, or are they gonna turn into a huge advertising machine? For like a company like Google, right? So, I mean, at these valuations, you almost need a couple of things. You either need every major corporation to like purchase software from these guys, or you need to put a bunch of advertisements on it because the average person is likely not going to pay a bunch of money for this. I mean, maybe eventually it'll be like Microsoft Excel, right, or Office or whatever, where people will pay a small subscription fee. But at these valuations, you need something, right? So whether it's every company in the world buying up their software, or banking on a bunch of individuals, um, subscribing, which will happen. Um, you got to subsidize, you got to make money somewhere. So is the eventual outcome going to be advertisements on all of this sort of stuff?
Yeah. I've run some numbers on that with that possibility. So the assumption has been, okay, can AI be bigger than advertising plus all IT spending and stuff? And if it is that justify it? If it's all, if you get to the kind of advertising level per person that's spent in the US for the whole world, then that's one thing. But right now, per capita spending on advertising for US is a lot higher than like the global population. And these things are always like assuming that billions of people are going to use them and everything going. So that's a pretty big difference. I mean, a poor country is 1/10, often the monetization of like eyeballs, the value of it as it is in like the United States or something. So um, all advertising in the US is about 2% of GDP. So you can run the numbers and stuff. That doesn't really work out. And then IT things, could be close to 10% or something. So that gets you a lot closer. Um, yeah, I mean, the big things that are different are, which we've seen recently, are look the multiples on these are like 10 times sales, which there's never, there's all basically never in companies this big, the biggest companies in the world that trade at those kinds of valuations versus sales. And then the other thing is, of course, and in this NVIDIA, this does not apply to, but for all the others like Alphabet and everything, is that they are significantly like not free cash flow generative now. So the earnings that they have are not generating cash that way, because they're
Meta's a good
reinvesting
example
all
of
the
that.
cash. Yeah, Amazon too is a good example, and Meta, yeah. And especially because there's also the stock-based compensation. So, cash flow from operations at Meta is like this, trailing 12 months is like 107 billion there, and then their spending on Capex and stuff is like 62. So you have something there where that's like 40 billion or something on that, and then actually 18 billion of that is stock-based compensation. That complicates things for taxes. But putting that aside, you can compare that to things like the actual reported earnings, which if we go to the overview, it could be pretty easy to see what the reported earnings there are. So let's see. Yeah, so like the actual free cash flows, I mean, very low versus operating profit. That's less than 50% of that. And historically, the companies have paid pretty low actual tax rates and things. So they used to have really, really high. If you look now, Meta actually was the first that this was. Well, Amazon too. Amazon and Meta both since COVID, because Meta has been doing the metaverse stuff, and Amazon went really big into like distribution and also AWS stuff. So those two actually had been investing a lot in capex. But there was others like Microsoft and Alphabet that were really low on that aren't anymore. You can just see it in the PE versus the enterprise value to free cash flow. Enterprise value to free cash flow is now higher for these companies. So it's fascinating that way. And also on things like Oracle, which will be like a high debt. I mean, it'll be like a risky credit and everything, which is interesting. Because there's just so much capital that they're going to need to invest some of these, which is totally different from like NVIDIA. NVIDIA will just be, I'm sure they'll be diluting a lot too, but they will be minting cash, because they just are making something, selling it, and collecting the cash. So they're going to have the kinds of, like, if you look at these gross margins, operating margins for Meta in the past, and then turning that into cash, that's what NVIDIA will look like now. So.
Well, the good news is if you're a Meta shareholder, is I think today they announced that they're going to curtail the spending on the metaverse, the capex that was going into that, because now they're focusing on this whole other AI thing. The most fascinating part about the metaverse thing, I mean, from like the point of finding product market fit, I think pretty much everyone that I spoke with, and both, reading online, Twitter, sort of getting the pulse of everything, most people thought it was a really dumb idea. Versus ChatGPT and these LLMs were pretty much straight from the beginning. Most people could see like a use case for it and worked with it and could understand it. There's bugs and it hallucinates, but there's something there over time where it could become better. Whereas Meta, I think, with the metaverse, everybody, it was like consensus was this is silly. And they're spending, I don't even know what it was, tens of billions, probably more, 50 billion, whatever it was, on the metaverse. And they didn't have the product market fit. Nobody really wanted a world like that, at least right now. So
Yeah.
interesting. I think Zuck, when I think about him, I think about him as being a great capital allocator. You have
Hmm.
Instagram, you have WhatsApp, you have what else? He tried buying Snapchat, which,
Hmm.
whatever. Um Palmer Luckey with virtual reality, which, that really hasn't taken off as well. But WhatsApp and Instagram, those have to be one of the greatest acquisitions ever for a company. Um so yeah, just a little critique, I guess, which doesn't mean much, but I think if I was a shareholder, I'd be like, great. They've shifted gears from the metaverse to now spending on all these data centers and all this other stuff.
Yeah, and the actual decade-long results and stuff are way better than the other companies that we're talking about. I mean, with the exception of NVIDIA, which is all driven by the last couple of years, that the 100% growth per year and stuff. But they've had higher profitability and cash flows and everything improving at Meta for a long time, even with investing in all that stuff. So, um, but it is similar to what we're talking about with Alphabet. It's like, an advertiser supported business is like how they actually get all their money. It's not necessarily how they spend all their money, but it is kind of where they make all their money still.
Mm-hmm. Mm-hmm. And then Instagram Reels, right? That's the biggest. Everyone likes to, and the industry likes to talk about uh Zuckerberg, that he likes to copy, right? So you have TikTok, now there's Instagram Reels, and then they all kind of have their own
It
version
reminds
of
me a
it.
lot of Microsoft. Meta's always reminded me a lot of Microsoft that way. Yeah. And, 40
Like
years later or
Microsoft with
something.
Apple.
Uh, Well, with Windows and Office, and in terms of with Bill Gates and Microsoft in terms of their strategy over time and everything, yeah, you can afford to have a lot of things fail if you have a couple things that are the dominant things that you have, and you try to crush the competition early on to do that.
Mm-hmm.
Um, yeah.
What are your thoughts on this circular nature of what's going on in AI, right? So NVIDIA investing capital in
Yeah.
OpenAI to fund,
Yeah.
massive stuff with Oracle, who in turn uses, I guess, these guaranteed contracts to purchase, billions of dollars worth of chips from
Hmm.
NVIDIA. I mean, Elon was up with Jensen from NVIDIA. I don't know if they're, in front of the Saudis or what. And they were asking Elon how much he's going to spend on these, NVIDIA chips or just on AI in general. And I think he was like, I don't know, like 50, 100, 200 billion, whatever the number. Like he's just so based that it's almost like he knows that all this is silly. And Jensen was like, stop or whatever, like stop that,
Hmm.
like stop being like that. So what are your thoughts on just the circular nature of what's going on? So much capital. I mean, there's reports that GDP would be, I mean, awful right now if we didn't have all this AI spending. And I know you could say that about a lot of things that happened throughout history, but it seems like everyone's just all in right now. Gotta dance while the music's going. It's that type of moment.
Yes, it'll be interesting to see, just like with the internet, how much of this really happens. Because these are some announced deals and things which may never happen. And then raising money doesn't mean that you spend all the money that you raise. It's kind of like, extreme thing of this is like private equity things and some of those funds and things, this, that they announce that they'll raise a bunch of money and stuff. They do, and then they, can't spend it. They're, we'll raise X amount to invest in distressed whatever things. And then sometimes you get to spend it all and sometimes you don't. And so there's all these steps to it. What's interesting is like when you look at some of the things from like utilities, for instance, have been saying it's not a big, like, calm down. We're not going to be supplying that much electricity to projects because there's not really going to be much that's going to happen and need to be done that we get proposals for all sorts of stuff for applications. Everyone wants to get in there so they have the opportunity to do it, and then most of these things don't go forward. I think the thing that'll be most interesting is the most of these things, until we talked about something like the Oracle thing and stuff, did not require them actually going out and raising money to do this. And so, I don't know that there is a lot of capital when we're talking about some of these. I mean, it's a totally unrelated thing, but like Netflix saying like what they're going to use as a bridge loan to buy Warner Brothers is insane. And it's not big versus the market cap of Netflix and stuff, but it's big versus the ability of Netflix and Warner Brothers to actually like pay down that debt within a reasonable amount of time. So in a world where in a world where it's easy to borrow $70 billion or whatever they want in longer term financing, eventually it's not a problem. But if they want the money and the government wants to run a huge deficit and these companies all want to spend on this stuff, there'll be higher cost to all this stuff over time. Like it's not, we're not, you're not going to have really low rates and stuff for that. And you saw that and that's why I mentioned the Oracle thing, is that at first it was like, how's Oracle going to do this? But the stock shot up and stuff. And then over time it came down. There was more people thinking about what that would actually look like, how much money you'd be borrowing, how much money you'd be spending, and what kind of return you would need on that over time. So it's just a huge shift. We're talking about things that are like had the economics of, some dominant newspaper thing saying we're now going to build railroads. You know what I mean? That's kind of the shift in the economics of them, which is possible if there's a lot of money to invest in that stuff, but it would have to go to that and not to other things,
What are your thoughts on the Netflix Warner Bros. Transaction that's
it's
going to take
interesting. It'll
place?
be very, very contested.
Says
So
is comprised by who? The administration?
the trade associations of the theaters will be against it. Europe will be against it. The Trump administration will probably be against it.
They already said that they're looking at it very skeptically, basically. I think it was the quote that was on CNBC.
It's a Delaware corporation. It clearly put itself in play, and so they'll have to decide whether they want to sue over things and stuff. But there's really big breakup fees associated with this. So like it's not like, I don't know what will end up happening, if it will go to lawsuits and things. But I mean, they will be able to argue, look, if they fail to get regulatory approval for this and stuff, we get paid a ton of money.
Yeah, here you go. Netflix. First of all, let me just go over the hold on. The transaction is comprised of cash and stock and is valued at $27.75 per WBD share. That puts the equity value of the deal at $72 billion, with a total enterprise value of approximately $82.7 billion. And then let's see, as part of the deal, every Warner Brothers Discovery shareholder will receive $23.25 in cash and $4.50 in shares of Netflix common stock for each share of WBD common stock outstanding following the close of the deal. But what Geoff is talking about, and this is sort of unusual, you don't see this much, Netflix has agreed to pay a $5.8 billion reverse breakup fee if the deal is not approved, according to a Securities and Exchange Commission filing. Warner Brothers Discovery would pay a $2.8 billion breakup fee if it decides to call off the deal to pursue a different merger.
Yeah, and that's big. That's huge versus the amount that's normally done as a breakup fee. Actually, both of them are quite large.
So do you do that? Do you put that breakup fee on Netflix in case somebody comes in over the top for a higher bid?
No, I believe that if the deal isn't approved, they have to do it. So if it fails regulatory approval. Yeah. So in the airline case, right? So that did happen, right? With you had a couple airlines that were fighting over that when there was a fight to say that, look, you should go with the deal that isn't necessarily the best deal because it'll actually get approved. And then actually that airline ended up going into bankruptcy, or basically filing twice, I think. So let's see.
And it says Paramount's final bid was $30 a share, which was received all cash too.
Yes.
All cash.
And that's part of the other thing, because do you have what they say the market value is? So that it was 72 billion, because what did they say the enterprise value is? Because they're reporting different things. So let's see. If you have that at the top, we can figure this out. So it says 72 billion. So I believe So if we go, I believe that means that Netflix has to come up with about 60 billion, 59 billion, something like that, to actually pay the cash portion of this, for instance. It's a huge amount of cash. So that's part of the interesting thing, because they're using so little stock. And then why use any stock at all?
Yeah. Yeah. Like,
I mean,
what's the
if you
point
use
of
any
that?
stock at all, it makes it look inferior by a lot to people. They obviously said we have to, for some reason, use a little bit of stock to do this. And so it's an interesting thing. But what if you go to Netflix right now? I don't know what their situation is. Netflix also has large commitments to. They have a very complicated situation in terms of like cash flow. You can't really evaluate their free cash flow very easily, because they have commitments years out to, like, as any like TV station kind of thing does, that a TV network does, because they've committed to buying things in the future. So if you look, their current situation is that they have, what it says, they have 9 billion in cash, and then they have, let's see, and then they don't really have debt and stuff. I'd say that the total liabilities are long-term liabilities that are probably associated with, those sorts of things. So future obligations for things. So I would say, I mean, basically have to borrow all that money to buy it.
Mm-hmm.
Yeah. Which is interesting, but um I mean,
Why go with Netflix offer instead of Paramount?
well, that's what they'll fight about. So one is, what does it mean for management in different ways, right? So like, for instance, does Netflix keep management of things and stuff, and Paramount doesn't? That's one part of it. Um, and then the other thing is like whether it's a better combination of things in some ways. And in some ways it is a better combination of some things, although more likely to upset people and have a fight over it and stuff for the antitrust things. Yeah. I mean, Netflix allegedly had said that they promised to honor commitments that distribution. It said that they would honor distribution agreements through 2029 that are in place. I don't even know what that means exactly, because normally there's not necessarily contracts in place on that, and I don't know that you would have decided what you're going to do with movies for years into the future. So, I think for the next couple years there might be things about that, but not beyond that. So they probably mean distribution, and other things would be things that they have contracts for a longer time. But theatrical distribution, I don't know why they would have contracts, any sort of agreement in place for 2029, 2028 and stuff. And they're talking about, we'll keep it through then. So historically, the reason it's a big deal for movie theater stuff is that Netflix doesn't release anything in theaters. They release it only to the minimum amount to do that. Whereas Amazon, which owns MGM, and Apple both do theatrical distribution, and of some pretty big movies. For instance, F1 was an Apple movie and got a theatrical release. Whereas Netflix has had some really movies that would have been pretty big and won't release them in theaters. So,
Yeah, I mean, that's the question that the market is currently asking, is what's going to happen to movie theaters, right? Like movie
that's
theater
presumably
stocks,
why like
Cinemark,
Cinemark is down.
they're all
Yeah.
selling off. Yeah, 8%.
Yeah.
We could see Marcus, I believe, was
Yeah.
also selling off. IMAX. Um, and what is that? I mean, is that just being worried about, the theatrical window? What is that?
Yeah. So Warner Brothers is the biggest distributor this year. It has about 25% of the market share in the US. That's very unusual. It's really, I put their market share like 15, maybe in a normal year, percent at best. They've never had a year where they were 25%, and Disney will probably still pass them by the end of the year. But they're basically, as of now, like the theater owners and stuff can say this is the biggest distributor in the United States. It's never the biggest, but it happens to be for this year. And it accounts for 25% of the market, which is true as of now. So you're taking out something that is, a quarter of the theatrical market. And Netflix will try to agree to a bunch of things, probably, to say that we promise we'll do this, this, and that. Those are tough, though, because we talked about Meta, Microsoft. There's plenty of cases where companies have kind of said that they would do things, and then it's questionable whether they really did them or not,
Mm-hmm.
So that's always tough.
So stock's
Yeah.
at $25.78. What do you think the odds are that this goes through
Oh, ooh.
in a
Uh,
timely manner? Like how long?
no, that this particular deal goes through at this price in a timely manner, not very high. But that
Yeah.
doesn't necessarily matter because you're not betting that this deal will happen this way, but that it'll go even higher or it'll go lower. And if it goes lower, will it fall apart that someone else will be there bidding for it? Um, I mean, like if you want a lot of cash, the only thing that you want is you would prefer that, I mean, Netflix was able to get banks to give them a loan. I mean, as of now, they don't have it or anything, I guess. But I mean, they obviously made this assuming that they had a group of banks ready to give them shorter term financing that then they would, have a bond or something to replace it with. you know, a few months from now, a year from now, whatever, you don't know if it's not easy to borrow $60 billion or something. So, any of these could fail to materialize because you need to borrow a lot of money to do them, right? If it's a stock deal, it's a different story, but these are both offers to do a lot of cash. And then Warner Brothers itself, Warner Brothers Discovery also has a bunch of debt too, and is not generating, it wasn't really generating cash to service that very well. They were focused on doing that, but they were already in a situation like that. So that's the part that's kind of trickier, I think. Is not like that there won't be an appetite for them to do it. It's just like, will someone be able to give them enough cash to actually buy this in all market environments? That's why if you have someone now who you want to close the deal with, that would be better than you don't want a really, really long review and then, but there's a big breakup fee, you know. Um, Yeah, it's a really big breakup fee actually, right? So compared to the deal size, I don't know. I bet that's 5 times to 10 times what the size of a normal breakup fee. I mean, a lot of times breakup fees are like 1 or 2% of the deal or something.
Hmm. Mm-hmm. Mm-hmm. Before we move on, I wanted to get your thoughts on Amazon, because that is, one of the FANG stocks that's less talked about nowadays, I feel like.
Hmm.
Um, uh, so we're currently at 2.5, call it 2.4 to 2.5 trillion market cap and enterprise value. QuickFS has a 32 times earnings, 3.5 times EV to sales. You look at gross margins, you look at, growth obviously through the pandemic was stratospheric and it's come down a bit. But why don't you get your thoughts on Amazon where we are right here? Because to me, this looks like one of the FANG type stocks that obviously hasn't gone up as much as the other ones have. A lot of reasons for that. But yeah, want to get your thoughts on Amazon.
I guess it's kind of like Salesforce, right? Is the same kind of issue where people are like, are they going to reaccelerate and is this better for them in time? Or is it because all the stuff Amazon's in, they're not growing all that fast compared to their competitors anymore in those things, probably. They can't be like gaining they can't be, other in each case, they're not going to be the fastest growing. They're not going to be the fastest growing online retail operation. They're not the fastest growing streaming of anything. They're not going to be the fastest growing in terms of AWS or anything at this point. They're just the biggest in those things. And the biggest isn't usually the fastest growing. We've gotten used to that where Meta can be already the biggest and then grow for 10 years at being really big, that's unusual. That doesn't normally happen from, or we talk about YouTube or whatever that doesn't normally happen. So yeah, and they're firing a bunch of people and stuff. So they obviously know that.
Mm-hmm. Mm-hmm. Have you looked at
Their
FISV at
profitability
all?
has, yeah. So these are interesting ones.
Every payment, PayPal, Block, which was Square.
Yeah. So
What's the other one?
I will warn though that Fiserv has a added wrinkle here, which is interesting about a couple companies that we looked at. Now, Cinemark does not fall into this at all, but a bunch of ones that we didn't talk about just now, but that I pointed out before, their stocks are really being crushed, have a credit part to it that they're a bit aggressive on things. And that's the situation here. This company is like I was saying kind of about Oracle. Not Oracle's a great business and everything, but it was always more aggressive in terms of its financing than Microsoft and those companies. And this is, normally a company like this with these kinds of margins, these operating things, you've seen lots of other core processing things and stuff that don't have any debt or anything. And they have, if you look at their 10K and stuff, it's like a really complicated, like they do, it's a constant thing that they're always doing to kind of maximize in terms of how they borrow and everything. And so, so what do we have? We could look at cash flow from operations or something, because the operating profit recently has been, 1.5 to 3 million.
Yeah, first I just want to pull up the chart.
Yeah.
I'm sure everyone listening is familiar, but we hit a high of, it looks like March of 25, so earlier this year, of $237 per share. And then it was just consistent selling pressure. And I started looking at it when it was going down. And I mean, we followed core processors. We've talked about these companies before. They're generally pretty dominant businesses. So it's something that was interesting, but didn't do anything about it, but was just watching. And I was like, gosh, this company just cannot catch a bid. I mean, and to me, it looked like a very large fund or funds, or just constantly just selling, just getting out. So, from like if you want to put on your Stanley Druckenmiller hat of like respecting price action, this was just it, like not picking that bottom. And then they reported Q3 earnings. When was it? Maybe October. And they announced that, so there's a new CEO that's in, and that previous management, they were very aggressive in their guidance. A lot of the growth that they had came from Argentina inflation, which I don't even really understand, to be completely honest. And they reset guidance, and the stock went from, call it $126 to, as you can see on the screen, $65, and we've been hanging out right here. So obviously all of the TTM numbers look very cheap, but again, I'm kind of thinking like, is there more cockroaches here? But, just kind of, taking a step back, I've always been pretty shocked of a lot of these businesses that more competition has not like come at their like their merchants and their banking and all that sort of stuff. I mean, these are very high margin businesses, and I've always just been shocked that that competitive position hasn't really eroded as much as I would have thought. So I don't know if that's like
and
what's
the
going to
results
come up
they
soon
had
or what. But
the results they had weren't some sort of terrible thing that way. I really don't think that the competitive position of this company, or there's others like this, that was all that bad. I think that it was originally pretty premiumly priced, the stock. And then, historically, it had always been in a higher multiple, because we're talking about something that, like a normal multiple is, these things are 12, 16 times EBD, but actually now it's like 7. And then, like we said, there was a lot of debt for financial engineering purposes. And then I think what they're kind of saying is that they were raising prices on, which we've talked about. That they were basically, if you read between the lines, they're like, we were giving bad customer service and raising prices all the time. Is kind of, because they said like, we're now focused on client success and thing. I mean, I don't know if those are the words they said, but that kind of thing, like they kind of make it sound like their customers were mad at them. So that was interesting. I also, with these things, sometimes I think it's guiding. So this kind of thing where you have this big drop and stuff tends to be very, very predictable businesses that were guiding you something, and then they have some sort of problem that happens almost at the exact same time. I don't think it was like the same day. Stride, which is LRN, dropped like 50%.
yeah, that's another one.
That's a very predictable business, and it wasn't a big surprise and stuff. And it had an IT issue. It switched platforms that it uses, which is what's interesting about that is that's quite thousands and thousands of people would have known about this and stuff. Like anyone, analysts actually covering it and trying to check on how the business is going, would have known about this issue. But what's the company supposed to do? And now, they'll be like, well, they should have told us something. But you're going to tell you them at the end of the quarter, where you tell them every moment as you're having a problem with the switching over to the systems they have. But yeah, they got all their customers mad at them and stuff by having a botched switch over. But it may be fine eventually. Yeah.
Before they reported Stride, so ticker LRN, the stock price was $151, and then it opened up $66, and we're hanging out at 62 right now.
Yeah. And that, like, the ownership of that stock and what people were expecting and stuff just reminds me a little bit of what we're talking about, Fiserv and stuff. And it just happened that I think the dates are not that far apart that these happen, because they both are reporting the same sort of things. But very predictable. clients for a long time and stuff, because this company runs like schools. It does the, online schools for schools. Like, you outsource to the school district to them and stuff for doing online learning and things. So you can see they've done better since COVID and everything, but actually long-term predictable kind of thing. And like, gotten a lot better in terms of profitability and stuff recently, scale as well. And now looks really cheap, same as this, where it's like had a premium multiple to a discount multiple. What's interesting about it too, though, is this, this stock was not dropping ahead of time. This was just, there was like no information about this that people had. And it really plunged.
Mm-hmm. Mm-hmm.
Well,
And
it's a
what was the
rollout of
reason
something. They
for
didn't.
it?
So it's a rollout of power schools. Officially, I don't think they said that in the press release and stuff, but you can figure that out. So, which is a thing that tons of companies use in this area and stuff. So, I mean, Phil Fisher talked about like the problems of like a new plant startup and like things going wrong and stuff as being really a good time to invest in something like this. There are cases, I can remember things 25 years ago or something, where a company that's gone on for done amazingly well after that has been because they had a system that they changed, that they said we're changing our customer relationship management stuff and things, and everything goes badly. And then, after a few quarters, it's fine. And the business is back to what it was before. But yeah. And if you look at the results here, like if you look at the press release or something for Stride, or you could do the same thing for FISV. What's amazing about these are the actual reported results. There's no way that someone who didn't know what expectations were could read that and think that the stock would drop 50% or something, or whatever it did drop. If you see, so what was
Strong
their
demand
actual?
drives growth.
Yeah, but no, I mean, but look at the actual results, right?
Mm-hmm.
Diluted earnings per share were $1.40 instead of 94 cents. Adjusted
Yeah, net
EBITDA, I mean,
income up, everything up,
adjusted
up and to
earnings
the
were
right.
up, yeah, of course. So look, so revenue's up 13% from the year before, all these things, right? But what were people expecting and what had they been telling them before then? Um, you know,
So was this really just a reset of expectations type of
and it's
quarter?
interesting because I don't think that the expectations long term here will be that much of an issue. So it's interesting how you evaluate it from the two things. My guess here is that this is not a big deal for this company. I'm going to say, just my guess, and it is a big deal for Fiserv. But it has to do with like the information and how much bad things were happening that they were spinning in a positive way. And there's lawsuits here and everything. And so yeah, I think that there's probably a lot of that in the first case and not in this case. But that's a guess. But that's because of what the issue was. And then I think it makes total sense that they would have been blindsided by this and stuff. And also, by the way, like the top management wouldn't have expected this. It's kind of like, probably at every level, people are kind of hoarding the information of being like, this is going really badly, but they're telling their manager a little bit less about that. No, we can still hit that date. No, whatever, all the way up. Whereas I think in the other case, there was more aggressive engineering of things for years. Probably that's the more likely explanation for why that was happening. In terms of what they were saying. But this is I mean, I don't know, but this is totally believable. Of like when you talk about a one-time thing happening to a company, this is exactly what it would be like. Is doing something like this. You totally misjudge something like a rollout of something to switch all of your customers onto a completely new system. And this is something about like in terms of what this company does administratively and stuff. We're talking about schools that they have are thousands and thousands of kids in each school, and they have lots and lots of schools and stuff. So it would be as if the government decided, oh, we're changing how we're going to send out social security checks this week or something. You can imagine how badly things could go, right? So look, this kind of stuff happens all the time. Like, and some other things, people don't get all that worked up about it, but we've seen major websites go down and whatever things, because they all use the same, cloud thing, or they all used whatever it might be. And people understand that are like, okay, it'll be okay later today. It'll be restored, but in this case, I don't know how. My honest answer with this is I don't think that anyone like covers the stock or understands it or anything, and that there's no constituency for owning it long term. And that probably, what's the share turnover and stuff? That's the other thing. I think it's very Like I just don't think it's yeah. Well, of course that's calculating based off of that day. But yeah. Um I just think it trades a lot and stuff, and that people are just looking at the numbers and not really trying to learn about the business or something, probably. Like it probably you know what I mean? Kind of looking at it on like the factors and stuff, you know what I mean? Just like as a thing that's made up of numbers and stuff, and not what is the business and what really happened here.
I'm like looking at it. I was like, is this like a pod shop hotel and they just punted it? They got caught off sides, or yeah, I mean, it's just to be down
It
that
sounds like the
much.
kind of thing that you go on CNBC and be like, I'm really like the, you know, since COVID and stuff, this is changing, and you know, there's not a lot of like what do you want to call it? Remote learning, like pure play stock type things, like that this is what you would do. And it used to be a pretty small company actually, but as you saw, like because 10 years ago it was only making like 10-15 million dollars, right? So it got into that category of being a couple $1 billion where now people can own and everything. But other things, like in terms of its finances and stuff, it's not aggressive the way that FISV is either and stuff. And I don't know, I think they're two very different situations that way. That doesn't mean that they're not both good or something. I don't know, they could both be, but I just think this is like the kind of thing where if the market is inefficient in some way, and this is this kind of thing. Because I think this is stuff that every day we get 5 different things about, every little rumor about anything happening in any company about AI stuff, right? Oh, this model's a little bit better than this one according to this person, whatever, you know, like they whisper about it. And there's nothing about that with this company. It just surprises them, you know. I just think that's kind of what we're talking about.
Well, Fiserv was the top 10 buy last quarter in Q3 for hedge funds that filed 13 Fs, as you see on the screen. So that'll be an interesting one to follow
Yeah,
along.
United. Yeah, I'm trying to remember how do United. Well, they started buying United Health and stuff too ever since that happened. And I think at first, at least, that definitely did well. That bet, yeah, um, yeah, these super predictable kinds of companies that way. Um, but like you said, there has been a thing like payment type things much broader than that we've noticed, right? Like there were a lot of them until now. The 50% drop is something totally different, but during the year, that was something that's noticeable for a lot of them. Yeah.
Okay, so we have a few questions that we could go through on the podcast. Follow me on Twitter or X to be on the lookout for next one. Let's see. We can only go through. We don't have a lot. I actually haven't been tweeting a lot, and I've noticed my engagement has gone way down. So I guess I gotta get back to tweeting a lot. Has Geoff looked at HGTY? What does he think of MKL's plans? Are since they converted all their shares to common, keep acquiring more? Question mark. So I guess we two questions there. Have you looked at HGTY?
No, let's look up HGTY and see what they're talking about here.
Haggerty Inc.
No.
Insurance. The company engages in the
No.
underwriting, selling, and
No, can't tell you
servicing
anything
collector
about
car.
this. No.
Anything from a high level overview or anything like that?
No, I know nothing about insurance for like collectible things and stuff. But I mean, Markel does specialty insurance for all sorts of things like that, so it's not weird that they would do that. I just don't know the situation.
Markel. You have any thoughts on Markel?
Um, no, but it'd be
Or
interesting for people to
insurance more
look at and stuff
broadly?
for insurance. Oh, insurance more broadly and stuff. Yeah, it's not. I mean, for the more general things, is not a good year for insurance things. It's a good year to be needing to get insurance, not a good year to be an insurer right now. But it was a great year. We had a couple great years to be an insurer in the last few years. So premium growth not going to be high, you know.
Yeah,
For the most.
basically everyone I know has complained about their insurance going up over the past few years. So
Well, they don't have to worry about that right now. The shoes is on the other foot, or however you want to say it. Rates are
yeah.
not strong right now. Yeah.
Why is that?
Um. So a few factors, right? So like one is an inflation factor, right, which tends to lag that insurers don't raise their premiums fast enough. Two, in some extreme cases, insurers intentionally gradually increase pricing so that they don't lose all their clients and stuff. So like, this isn't thought of so much as a insurance company, but Front Door is a good example of that, where they have like, they want to retain like 90% of these people for these warranties on like, you know, if you need repairs done in your house and stuff, right? So if that goes up so that a repair visit costs like 30% more in 2021 and 2022, they want to raise it like 10% a year for like 4 or 5 years in a row to get there. Not they have tables that tell them, if we jack it up 25% in one bill, we're going to get people that we lose, and it costs a lot of money to reacquire them, right? Like on advertising, on doing all these things to get them. So that's an issue. And then honestly, a little bit of it is just investment income. So when rates are nothing, then that's different than when you are making a bunch of money off of your investment income. You become, you prefer to be able to, you now start thinking about, as people always talk about insurance stuff, is like, oh, well, we don't actually have to make a profit because we can make a profit on the investment side. We don't need to make any underwriting side.
Let's see. Jeff's take on the current housing market in historical context would be interesting. How home builders are valued today compared to previous booms and busts, and how he sees the current situation. Perhaps a bit on the now seemingly trend to be more asset light with using third party land banks. Some of the builders, not all. So we could pull up some builders. Green Brick Partners, we've written about, talked about a lot on the podcast. I kind of think it's only a matter of time before they declare housing a national emergency and all these stocks just take off like crazy. I mean, it's obviously front of mind for them because home affordability, I'm sure you've seen the numbers. First time home buyer, 40 years old in America. Yeah. So that's gone up significantly. So yeah, something that a lot of people are talking about recently. It's very I don't know if you want to call it bipartisan, but yeah, definitely something that is on a lot of people's minds. But yeah, so do you have a general thoughts on
well, I moved from
housing?
an area in Texas to an area in Florida, and
Yep.
house prices are probably going to be down in the area I left and down in the area I went to. And rents definitely in the area that I'm in now. Just because you can tell in terms of inventory building up and like trying to, there's so much effort to try to entice people with something other than a price cut, and things are sitting on the market for a really long time. That was the case where I was leaving, and it's the case where I am now. So, but those are places that went up so much in the boom, right? Because they're more expensive city places, and like um with basically in the South with like good weather and stuff, right, that people move to. So that's not the situation that's going to be everywhere else. But I mean, recently there seems to be some things, but I don't think you're going to see house prices and rents going up that much from like right now on for a while. They definitely seem to be kind of turning over. And that's just probably just momentum and like financial conditions that it just eventually that happens, right? So, but I have no idea in terms of like builders and stuff. See, that gets complicated because it depends on what their business model is, where they are, and then also, like you talked about, how much of a difference does it really make in terms of the actual amount of supply that actually gets built or anything like that, right? Their business is not just like, they're not making some bet on owning a bunch of houses that have to go up in value or else they can't make money or something. You know what I mean? That's not what their business is. But I wouldn't expect like the value of homes or the value value of multifamily, properties and stuff to like go up in the near term. That's something that happened recently, but it's not going to go up at the same pace in the future, just because you can just see that stuff is going to have to cut price to move in some cases right now, at least where I can see it.
You have any thoughts on the capital light nature of some of these home builders? So obviously people talk about NVR as being the golden goose of that strategy.
Yeah, that's good. It's good business. Yeah.
You ever invested in a home builder?
No.
Is that just not a
Well, that's
business
not
you'd be
true.
interested in, or what?
Not technically not true. I have invested in home builders, but not really because they're home builders. They did other things and they were cheap and stuff. But no, I haven't invested in something like MBR. I don't like the. I mean, I don't think that I can predict things better than. To me, it's the same issue of like oil things and stuff, right? Like, it's just. I just think a lot of people are paying attention to it all the time, and their predictions are likely to be better than mine and stuff. Yeah.
Yeah. I would say you don't want to be in an industry or a commodity or whatever where, Glencore, these guys you're competing with, uh, they know what you're learning today and they've known about it for, 2 months, but it's just coming across your desk, right? Those guys have such an edge over you. I feel like it's better to focus on these second tier things a little bit more off the beaten path. Like if Goldman Sachs has a trading desk of whatever you're focusing on,
Mm-hmm.
good luck. Right.
And they are all, not all, but a lot of them, of course, are more local and stuff. And I guess if you understand that local thing, then that's something that you could do well in. But then, of course, you don't have a lot of choices, right? So, same thing with what I was just saying. That what I was just saying might apply nothing to if you're looking at something in Pennsylvania or Michigan or something. I don't see why the dynamics would be anywhere the same as like Texas and Florida and stuff. But yeah, the people seem to. I mean, look, the pricing seems really optimistic here, which is interesting. But it's always hard to tell because right before the housing crisis, they had like super low multiples and stuff. So in a sense, people knew that those were really high and unusual times and stuff. So just because it's kind of like the Peter Lynch thing, because the multiples seem kind of high and stuff, might actually be a good time to buy and vice versa.
Mm-hmm. Mm-hmm. Interesting. Let's see. Capital Cycles from Marathon Asset Management. They recently took a position in Millicom, ticker TIGO. Telecoms seem to be in an interesting position cycle wise. Would be interesting to hear your thoughts on telecoms uh, with with the capital cycle and especially TIGO if it piques your interest. So we could look at TIGO. So Marathon Asset Management, if memory serves right, they're the ones that wrote, or someone there wrote the book Capital Cycle, I believe was the book, right?
I did read the book Capital Cycles.
I believe there's an affiliation there. I
Okay.
believe that's true. So do you have any general thoughts on that approach
We're
to
picking
investing?
say,
I mean,
to
we're kind of
investing. Oh,
talking.
that
Well, we're
approach.
kind of talking
Yeah.
about that right now with real estate, right? Like you had this boom, and then there was supply was trying to keep up, and here
That's
we
the only way
are.
to make not the only way, but that's how you make money in kind of bad businesses and stuff, is that you have to be right on the price and the cyclicality of it for the most part. There's occasionally, even if you have really smart people running and stuff, that's usually a big issue because you kind of can't. It's not very easy to, even if you're really good at it, it's kind of hard to outrun that fact. And if you're right about the cycle part of it, you don't even have to be very good about picking the right company. You know what I mean? If you pick a home builder that's cheap, going to survive, and things are going to get better, or you pick an oil company that's cheap, going to surviving, at the right point in the cycle, then you're probably going to make a lot of money. But we're picking a topic here that I probably would be even less likely to give an opinion on than housing stuff. Because at least with housing stuff, then I don't also have to worry about technology things and stuff. Telecom has always baffled me that way.
Why is that? It's sort of been a value investor fan favorite,
Yeah.
telecom. Oh yeah, for sure. Is that because of Gabel? I mean, what is that?
Okay, but like, so I read the book by the John Malone book recently, right? And I can understand it at that time, right? Because if you're someone who's focused on now, I mean, super leveraged, so like very risky, right? But in terms of the economics of creating a lot of value, I can totally understand that kind of thing. But when we get to the point where I'm worried about like the technology and stuff, technological change and everything, then where it's not a growth thing, then that does worry me. Yeah. I mean, a value thing, I at least like that I don't see how housing is going to change and stuff, right? So I have some more confidence in like cheapness versus tangible assets and even cash flows and things like that.
Mm-hmm.
Um,
Yeah, I
You
mean,
know.
and to your point about the cycle, I mean, anytime you're looking at a company where the price that it follows the industry, whatever the commodity that that company follows is the price of that is below the cost of production for industry operators, I'm instantly interested because that's when you reach the point where maybe supply is going to shut in, you'll get prices to rebound or whatever. You could be closer to the bottom of the cycle than the top. So that's generally a cue, or when people start talking about that, you should drop everything and kind of take a look.
Yeah, and I wouldn't buy into shipbuilding thing or something, but I don't think that's going to change in 10 years or something, right? But like we only have to go back 20 years ago probably. Um People actually thought there was a lot of value in like satellite TV operators and things like that, right? And then 10 years later, you would be amazed how much that number would be down. And then we take something like satellite radio or something 10 years ago, look at what Sirius would have been versus today or something, what valuation they put on it. And that's because of changes in, technology and also changes in consumption and stuff. Um,
Okay, so back to Netflix and Warner Bros. Merger. It says, what are your thoughts on it? Do you believe it will be completed? How will this merger affect theaters and the entire entertainment industry? And then someone else commented on that, saying more like with distribution breaking down as the barrier to entry for media evidenced by the coming destruction of the HBO Max brand. Is there any reason at all to assume these companies won't be fodder for unions and financiers while shareholders are left holding script?
um, Well, I mean, if the deals closes, then no, shareholders will be getting a lot of cash. I mean, these are cash offers, so I think shareholders will be getting a lot of cash probably. Um, uh, so they'll kind of not have the risk from that based on the deals that we're seeing, and those were the only things that I think. I mean, I don't know details of the Comcast one and stuff, but everything that we've heard is that it was a lot of offers to pay a lot of cash to shareholders right now. So if they if that goes through or any of the other ones do, then that's not the case for the shareholders. Yeah, I mean they'll get it. In terms of what it will do for, let's see, affect theaters and the entire entertainment industry. Well, it's things a little differently. I mean, one thing that you can talk about is look, the really big thing here and why Netflix would be interested in this is that this would combine, Netflix and HBO Max basically, which worldwide that is really, really big for streaming things for, so for paying to actually watch stuff streaming, movies, TV, all that, whatever, um, that that's a really big part of it. Um, and it's not hard to predict kind of that part of it. And that's the core business that Netflix is in. The theater one, that's the hard one, and that's where there'll be the opposition probably. Maybe not, but I mean, I just think that the opposite, like, okay, there's Disney Plus and Hulu is owned by the same company. Do they really care if Netflix and HBO Max are owned by the same company? And what does that mean to people? And, okay, are the prices really going to be that different? And how is the streaming? I don't think people are going to get real worked about that, at least in the United States. But the theater things will all talk about it and stuff. And then I also think in this case, Paramount will complain that the process wasn't fair and stuff like that.
Mm-hmm. Mm-hmm. Yeah, that'll be fun to cover. Let's see, just take on lots of movie theaters questions, obviously, because of movie theaters questions because of what's going on today. Let's see, take on NCMI and JJSF, also movie theater related. We can look at JJSF,
Oh, I see what you mean by also movie theater related. Okay. Yeah.
J&J Snack Food.
Yeah. They do things like Super Pretzel and stuff like that. They sell things that are that you'll see sold at they're away from home things. It shows you all the brands there. Some of them are sold in supermarkets, but these brands are mainly things that are consumed at like stadiums and movie theaters and things like that.
Mm-hmm. Any thoughts? We got $1.8 billion market cap, $1.7 billion enterprise value, 27 times earnings, 1.1
Yeah.
times EV to sales, 20 times free cash flow.
Mm-hmm.
Stable gross margin. Actually, maybe not so much. I mean, it's
Well,
ticked
that
down a
was
little
because of
bit.
COVID.
Yeah,
It crashed
most of these
during COVID.
companies,
Yeah.
right? Um, yeah. See, I mean, it's kind of pays a dividend. Return on invested capital has gone down even, post 2020 shot up and it's gone down now, the boom that you just spoke about.
Mhm.
Yeah. What are your thoughts?
I mean, when I owned the company, so we're going back, 20 some years, it was, you know, the 10-year growth rate would have been like, I don't know, actually for EPS or something, probably would have been 11% or something like that, in that range. And revenue would have been similar. And the PE would have been, in 12, 13 times or something. So obviously that's changed dramatically. It's just basically matured and stuff. You know what I mean? At that time was able to
Mm-hmm.
acquire different things. This actually looks a lot like other food companies that actually sell through supermarkets and things now. So,
Mm-hmm.
but the price of free cash flow and everything isn't crazy. And it's true that lots of food companies, even ones with absolutely no growth and everything, do trade, they tend to trade at these kinds of multiples. And, it's, obviously very safe financially and very predictable, but it's making the same amount of money that it was 10 years ago, basically. You know what I mean?
Mm-hmm.
So yes, if you have a free cash flow yield of 5% or something and no leverage or whatever, that's great. But how is that much better than having a bond that, yields 5% or something?
Yeah.
Now COVID won't happen again, so I don't know that the next 10 years will be as bad as the past 10 years and everything, but it's just like, no matter how high quality business is and how predictable, you do want it to grow to pay any sort of premium price. But to be honest, versus the market, I guess this isn't really a premium price. This is actually kind of just a price. I mean, 27p and stuff doesn't seem low or whatever, but that's kind of, that's not a peak. Let's see, they were earning $4 or something before, so 20 mid 20s or lower PE with no debt and everything. That's kind of like actually probably just the price for the market.
Mm-hmm. Yeah, definitely. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. This is the first time you're joining us. Be sure to check out all of our content that we distribute through YouTube and whatever podcast app that you use. If this is the first time you're joining us and you want to learn more about our money management services, even if it's not the first time you're joining us, go to focuscompounding.com or reach out to me at andrew@focuscompounding.com. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.